Hello and welcome to the market report from IG. Well, we've seen a bit of a risk-off start here in Asia. We've seen the euro dollar, the Aussie dollar coming under a bit of pressure thus far. Not a million reasons why this has happened. HSBC PMI print that came out on Saturday morning for us here in Asia showed signs of stabilisation after it was revised up modestly. It's still in contraction for the 11th month. If you actually look at some of the forward-looking indicators that we saw from that, for example, the new orders component dropped to the lowest level in about 3.5 years. This could be the reason why we're seeing a bit of a risk-off move, and people now very closely looking at what's going to happen with the PMI or the official print that comes out a little bit later today, which is expected to go back into expansionary territory at 50.1. So clearly the people who are holding long risk positions would hope for a print higher than 50.1 coming through. All eyes still very much on Spain. We are expecting Moody's to announce anytime soon. The review was conducted and concluded on Friday, so we should hear whether Moody's are going to downgrade the Spanish debt rating to potentially junk status. If they downgrade it by one notch, they would be taking it to junk status. However, what are the implications of a downgrade to Spanish debt, knowing that at some stage they could look to request assistance from the ECB, the EFSF and the ESM? Well, potentially that could be a good situation, because every basis point higher in Spanish yields bring them closer to effectively asking for assistance, which a market should like longer term. So people have been looking very closely, not just at the budget, which we saw at the back end of last week, which was relatively market friendly, contained more spending cuts as opposed to tax hikes, which people within Spain will probably like a little bit more, although there are still violent protests going on, and the market's clearly reacting to every protest we see on our screen. We did see Spain coming out over the weekend talking in what they call the Yellow Book, which basically details their borrowing costs for 2013. They are going to miss their deficit targets. They said their deficit targets will come above 7%, but that will include the bailout terms for their banks, which we got on Friday at $60 billion US, which are in line with expectations. So if you subtract those numbers, they should reach their deficit targets at just above 6%. However, the market going into 2013 is sceptical if they can get to their 4.5% targets, which they've set, because that implies that they're going to have negative 0.5% growth, which I think a lot of people think are optimistic. A lot of the investment banks are saying Spanish growth next year will contract by 2%, which is a lot worse than what they've been looking for as well. We did see that they are coming out and saying that they're going to borrow just over 200 billion euros next year in the bond market. 49 billion of that coming through new money, and the remainder in terms of borrowing that money for redeeming bonds. So that's a huge amount of borrowing this country needs to get away. So clearly any higher yields will cost a lot of money in terms of their interest component. So risk is slightly off today. We are looking for that official PMI numbers. We've just seen the Japanese Tankan numbers. On the face of it, that does look slightly better. We've got Chinese Golden Week this week as well, which might take a bit of liquidity out of the market. The equity market here in Australia looks like it might open a bit on the back foot, although the opening calls are relatively flat. We are seeing the market expected to open down about 30 points. So clearly the materials and the industrial stocks should be under a little bit of pressure, because that's generally the risk-off side of things. But it's all eyes now really fall on the week ahead. We've got a massive week, really culminating by the US payrolls on Friday. But the big 4 central banks coming through. The big one that we're looking for, of course, is the RBA rate decision tomorrow at 2:30 as always. It's going to be very interesting trading around that. We know that the credit markets are pricing in a 66% probability of a cut, whereas only 9 out of 29 economists are only calling for a cut. So 30% economists are calling for a 25 basis point cut, while the credit markets are saying about a 66% probability. Invariably, when you're seeing that, you are going to see some heightened volatility coming through in the Aussie dollar. So it's going to be some very interesting trading opportunities coming through tomorrow.